Happy New Year! Hi, this is Mike Maloney, and in this video, we're going to be taking a look at things to come. Not the 1936 film, which was a great film, by the way, but we're going to take a look at what might happen in the coming year and beyond in the financial markets and in the economy. And when you're trying to look into the future to predict what's going to happen, it's best to do that by looking through the lens of history. If you can find a similar setup to what is happening today, and when that setup if you can find something in the past and find how it resolved itself and what the outcome was, then the outcome is probably going to be pretty similar in the future. As Mark Twain famously said, history doesn't repeat itself, but it often rhymes. And there will be a twist. It will be a little bit different than last time around, but it's going to be quite similar. And so this is the S&P 500. We're going to be taking a look at this, and there's this great article that I was reading, and I want to show you just how important this is. It's titled, Why a Toxic Mix of Low Volatility, Passive Strategies, and High Levels of Leverage is Reason for Caution in the U.S. Equity Markets. Now, I'm going to try and make this more understandable for everybody because one of the things they don't do here is define things. So they're speaking to other people in the financial sector. We want to know what volatility is. We want to know what passive strategies are. We want to know what the leverage is that they're taking. And, some people don't know what equity markets are. Equity markets, that's the stock market. Equities are stocks. So, could low volatility be the quiet before the storm? If we go down here to the text, low volatility could be the quiet before the storm. So says Dr. Robert Shiller, the Nobel Prize winning economist at Yale University, adding, I lie awake worrying. Over the past 20 years, the volatility index has closed below 10 on only 21 days, 13 of which have been in the past 2 months. So that means only in the whole 20-year period, there were only 8 other days that closed outside this window of 13 days being in the last 2 months. And now I'm going to share something with you. I'm updating an old article. This is 5 months old. And there was already something extraordinary happening 5 months ago. And now we've got another. It's been 150 days, 5 months since he said all of this. So where are we at today? Well, let's take a look at the volatility index. Now, the volatility index is basically a measurement of greed and fear. It's a measurement of investors being too worried when it spikes up at these really high figures, when everybody thinks that there's a crisis that's going to go on forever, and too complacent, where they think that tomorrow is going to be the same as today, everything is going to be rosy, and the stock market is going to rise forever. Now, if you look at this minimum here, how they derive this is the spread between options, puts and calls on the S&P 500. And so it closed 8 of those days that he's talking about were back in this 2006-2007 period. And if you look at where the stock market was in late 2006, early 2007, it was just before this thing that's called a distribution dome. This is where, Wall Street was invested going up here, and then they start placing risky assets in the hands of the public. And so the strong, smart money moves all of the risky assets off of their books and sells them to the weak, dumb money, the average retail investor. And then it's that retail investor that gets slaughtered going for the ride down here. And then that retail investor will panic and sell, and the professionals buy it back and take they start the next ride. And so if you take a look at what happened with the volatility index here, it went way up and it peaked in late 2008 here. And so that corresponds with this dip right here. So investors were really worried, and they were overpricing the risk into the market, thinking that the markets were going to continue falling to zero. And this is exactly when that volatility index was peaking, is when they should have been going long, investing back in stocks and not selling. And so the volatility index is a negatively correlated indicator. This is when everybody is complacent and sure that things are going to go on perfectly forever. That's when you should be worried. And when everybody is really worried, that's when you need to be bold and take some steps. Now, I made as far as making a lot in a very, very short period of time, I positioned myself so that I would do well during this period of time. And every single day, I was doing very, very well. So it was, as far as a short time period goes, this was the densest accumulation of wealth that I've had so far, was during that crash. Now, you take a look at what's happening today, and this is just going up and up and up, and there is no part of volatility is the markets going up and down. There isn't any volatility here, and that shows in this dropping. Now, when he wrote the article, which was August 3rd, that only encompasses a few days here. So let's take a look at a close-up of the volatility index. So this just goes back to May, when it first dipped below 10. So it's the first time since 2007 that the volatility index had been below 10. And I'm going to look at an area chart here because it's a little easier to see. He's talking about the days that fall in the white area inside this rectangle that I've drawn. So there were 13 days. But what about all of this over here? That's what I want to count now. How many days have been added to that 13 days? And to do that, I'm going to turn this into a dot chart, which is incredibly difficult to read. It's an awful looking chart. But I'm going to zoom up on this area since September. And what this allows me to do, I'm going to ignore this one dot that's almost on the 10 line and just count the dots in here. And what we end up with is there's 33 more of them. So now there are 54 days that the volatility index has been below 10 in the last 20 years, and 46 of those days, or 85% of them, have been since May. They've been this year. And that is something that can't last. It's completely unsustainable. And this trajectory of the markets is also completely unsustainable. So let's go back to this letter here. The current streak of 270 plus days without a 5% drawdown in any of the major U.S. indices is the longest since 1996. Well, there have been another 150 days, so now it's 420 days. When this article was written, the Dow Jones was just at 2,500. So there's all of this that has been added, and you can see that there's no pullbacks there, none. It just goes up and up and up, and it's like total insanity. And so back to the article. Meanwhile, U.S. equity values continue to diverge from earnings. So Shiller's cyclically adjusted P/E ratio, or cyclically adjusted P/E, CAPE, has only been higher 2 times in market history, 1929 and 2000. Well, they don't define for people what P/E ratios are. And that's basically the price of a stock, a share of the stock in the company, divided by the earnings per share of that company. And so what kind of profits is that company having compared to the cost of each share of stock? And it's a very, very good indicator. And typically there is a fair value range, and that is somewhere around 12 to 15 times whatever the earnings are is what the price of the stock should be to be fairly valued. So let's go over here and take a look at it. And this is Dr. Robert Shiller's data. And what you see here is, fair value being in this area right here. And things have been out of whack for a long time. But That's even higher than 12 to 15. But so this is an area where you can expect to do well on your stocks. And if you buy them when the PE ratios are very low, stocks are very undervalued at these points, and they do incredibly well. If you purchase stocks from 1980 to 82 and then took that ride to the year 2000, you did incredibly well. That's the type of bull market that, with gold and silver, I'm trying to invest in one of these long-term bull markets, and the bull market in precious metals is not over with. And so in that article, they said that it had only been higher 2 times in history, 1929 and 2000. Well, now we're up at 29 levels or higher. And so let me see here. Yeah, we're just past the 1929 levels, or maybe just a little bit, same or a little bit higher. And there was only one other time, the dot-com tech bubble, the NASDAQ bubble of the year 2000, when stocks were more insanely valued than they are right now. And just to point this out, this is 2007, and this is the global financial crisis of 2008, the crash that just brought it back into fair value range, but not into undervalued. And so you know that this cycle is not done yet. We haven't visited undervalued. Whenever you go into a bubble, you have to visit undervalued before a brand new bull market starts. Bubble, undervalued, bubble, undervalued. And it's like that every single time except this past 2 decades. And the Fed just keeps blowing us back up into these bubbles. That's going to end soon. And I don't think we're going to have to wait very long. Evidence is beginning to mount that U.S. equity markets may be near a volatility-driven tipping point. Buoyed by the lowest interest rates in 5,000 years, now I got to stop here and let everybody know that 5,000 years is all of financial history. We don't have measurements of interest rates before that. The measurements we do have are very accurate going back a few hundred years, but then they sort of get spotty here and there. What they're talking about, the lowest interest rates in forever, is what they're saying, that they've never been this low. Right now, we have countries that represent 1/4 of the world's GDP, the gross domestic output. So all of the goods and services created in the world. Countries that represent 25% of the world's output have negative interest rates, which was not even a concept until the year 2008. And the reason that it's a concept and a tool that they're using now is because we have these insane Keynesian economists running the global financial system. They run all the world's central banks, and they think that this is a logical tool that they can use, these negative interest rates, to get an outcome that they want. And it isn't. It's an insane thing to actually charge people for the privilege of loaning them currency for a period of time and taking on the risk that currency is going to be paid back in depreciated, inflated currency, or not paid back at all, or they take a haircut or something like that, where you get paid back less. So you're taking on risk, and when you buy bonds, in the United States we don't have negative interest rates, but in a lot of countries they do right now, and investors in those countries have to pay for the privilege of loaning somebody currency for a period of time. That is insanity, and that means that there's still an extreme emergency going on, and the outcome of this isn't going to be pretty. Investors have taken on more and riskier leverage in search of yield. Now, these low interest rates push everybody into riskier and riskier investments because you can't buy a safe investment that's going to pay you some sort of yield. But here they're talking about leverage, riskier leverage. And low volatility would not be a problem if not for strategies that increase leverage when volatility declines. So as that volatility goes down more and more, certain funds and types of investments, people have taken on more and more leverage to a greater, when Bear Stearns failed, their mortgage-backed securities were leveraged to where they had 3% equity. So they were leveraged. It was just enormous leverage. If passive strategies have a bias to buy, then they can also have a bias to sell. Now, what are passive strategies? Passive strategies for investing is investing in indexed funds, for instance. An indexed fund like the diamonds or the spiders or the Qs. The diamonds are a fund that mimics the Dow Jones Industrial Average. The spiders mimic the S&P 500. So if you buy the Spiders indexed funds, you're going to get performance that looks almost identical to this. But there are lots of funds that are double long and triple long and even quadruple long. So when this goes up 10%, say, your fund that you're invested in is going to go up 20, 30, 40%, depending on which one. But when this drops 10%, your fund is also going to go down 40%. And these are run by black box trading. That's, it's all computer driven. And so with hundreds of billions of dollars of investments now linked to volatility, a spike in the volatility index could trigger a devastating algorithmic sell cascade. Algorithmic. They're talking about black box trading that manages these funds that hundreds of billions of dollars are invested in. And so when the market turns and it starts to go down, what they're worried about here is black box trading triggering sell cascade. So this is devastating algorithmic sell cascade, means it's a waterfall event. The market goes down a little, it triggers more selling, which then is going to cause margin call. When you have leverage, investors that go out on margin, when they leverage stocks, you put 20% down and you get to buy 5 times more stock than you're paying for. And what happens is if that stock goes up 10%, you make 50% profit. If it goes down 10%, you lose 50%. But what's going to happen long before you can lose 50% is that your brokerage house will come in and you will get what's called margin call. And you have to cough up, they'll typically at around 12% or something like that. They won't allow the equity to go below that because now they're beginning to take on risk. And so you have to cough up extra cash for them to not sell your position. You get like 24 hours, and if you don't cough up that cash, your position gets sold. And so what happens is when people get margin call, they will sell this stock or that stock on their trading platform and try and cover their position and bring their equity up to where it needs to be. And when they sell, that causes the markets to go down further, which causes more of these black boxes to sell yet even more. So this devastating algorithmic sell cascade is what an investor in stocks should be worried about. It's better to turn cautious too soon than too late after the downslide has begun. The lower the volatility, the more risk investors are willing to, or in some cases required to, incur. Now, where they say required, that's because the world's central banks have created this ultra-low interest rate environment, and there is, if you want to be invested, there's no place that is actually safe. The only things that I can see that are safe, that are definitely undervalued, are gold and silver. And during a crisis like this, investors are also going to run to other safe haven alternative investments. You're going to see bonds get a last pop. That's a standard safe haven. But the alternative safe havens would be cryptocurrencies and precious metals. So they're going to do very well. Assets whose performance is linked to volatility include a huge amount of money. Any spike in volatility, even to historic average levels, has the potential to drive a significant amount of equity selling, much of it automated. That's that black box selling that I was talking about. Such selling would in turn further increase volatility, which would call for more deleveraging and yet more selling. So that's that waterfall cascade. Refusal to acknowledge the existence of risk has become a pandemic. That is the VIX staying below 10 for so long. It is just, there's something really wrong with the markets. And this is the amount of margin that investors have gone out on. So this is the non-commercial investors, their net positioning, and they're way, way out on margin right now at historic levels. And when the stocks go down, they have to cover, meaning they've got to sell some of the stocks to come up with the currency to repay the brokerage house. And so we're going to skip down to the end here. Seemingly every day for the past 2 weeks, the VIX has set new records. Well, those records go for another 5 months now. As Goldman Sachs pointed out recently, there have been 14 low volatility regimes since 1928, and all have required a large shock, namely a war or recession, to end them. However, quantitative easing and the rise of passive strategies means history may tell us nothing about what's to come. Now, are they saying here that that this time it's going to be different, that this time everything will be fine? What they are saying here is that history, that this has made things so much worse, that this is going to be bigger than anything that history can teach us. And because the next sentence, and the longer volatility remains suppressed, the bigger the leverage bubble grows, and the more costly the correction will be once the passive herd is spooked. You know, I've been expecting for years now, and I'm usually early. I mean, I was early. I'll show you something here. This is the Robert Shiller's home price index. And I started warning back in 2005 when it was up here that real estate was in a bubble and that investors needed to get out. And it went all the way to 2007. So I was a couple years early before that bubble popped. But here we are again. Real estate is also back into a bubble. And so you've got the everything bubble with stocks, bonds, and real estate. And so this time, you know, in the year 2000, stocks crashed. In 2007, it was stocks and real estate. This time it's going to be stocks, real estate, and bonds. So this is the currency crisis that I have said is going to be coming before the end of this decade. And we're just about there. I don't know how much longer this can go, because if you take a look at what's happening now with the tax cuts and everything, the markets are just in love with this. So it could go a few more months. But I have a feeling that before the end of this year, that it's going to be a happy new year for precious metals investors, because things like this always end in tears. Look at the trajectory of this thing. It cannot go on forever. And the correction that's going to happen this time, with all the leverage that's built into the system, with all of these passive funds just tracking this, is going to be pretty horrific for the average stock investor. As Hyman Minsky once said, the more stable things become and the longer things are stable, the more unstable they will be when the crisis hits. And that crisis is somewhere on the road in front of us. It's part of the things to come in 2018, could go out to 2019, but I doubt it very much. It's going to be a happy new year for precious metals investors and potentially cryptocurrency investors. So if you got anything from this video, please like it, share it with everybody that you can. Subscribe to our channel. If you already are subscribed, click that little bell next to the subscription button, because that tells YouTube that you definitely want to hear whenever we've got another video that comes out. You want to be updated on that. And if you aren't getting notification of new videos, then go to our website, goldsilver.com, scroll to the bottom, and there's a place to sign up for our newsletter. Just put your email address in there, and every week you'll be notified when the next video comes out. So thank you very much for listening. Good luck, and we'll see you next time.
Cryptocurrency News Channel. Your new future. Thank you. Follow us on YouTube.